This is Money Guide with Mary Sterk from Sterk Financial Services. Now, here's Mary Sterk.
Welcome to Money Guide with Mary Sterk. I am Mary Sterk, founding partner and CEO of Sterk Financial Services. We're really lucky we have a handful of very talented female financial advisors who know a lot of things about money and finance. And so today we're going to have a couple of those advisors talk to you about a very important topic. You won't want to miss it.
All right, welcome to Money Guide. Kelsey and Julie here, sharing with you a super fun topic. Now, you know what they always say, there are only two sure things in life, and they are death and taxes. So let's combine the two and talk about taxes at death. I know not the most exciting topic, however, there's lots to plan and to know on those two topics. So Julie is with me today, and we are going to talk all about this topic.
Right. So the first thing we're going to dive into is estate taxes versus inheritance taxes. Are they the same and what is the difference? So that's the first thing we're going to cover. So Kelsey, why don't you tell us a little bit first about estate taxes?
Absolutely. So estate taxes are the tax on the estate before it goes to the beneficiaries. Okay, so they are
Mhm.
not the same thing. Estate and inheritance tax are two different things. Estate tax is on the estate before everything is distributed out. There is a federal estate tax on estates that are bigger than 15 million for individuals or 30 million for couples. So, and that's 2026 numbers. Those numbers beginning in 2027 will be indexed up for inflation. So if you have an estate that currently is larger than that, or you expect it to grow to be larger than that and outpace the inflated numbers, then you should be paying attention to estate taxes and doing planning for that. Now, only around 0.2% of all estates out there in the United States pay this tax just due to the fact that it has a very high exemption. There's not a lot of estates out there that are bigger than those numbers that I just mentioned. So it's not something that impacts a lot of people, but it does impact people. And so good estate planning done by people with the higher estates can help them avoid some extra taxes that their beneficiaries would have to pay or their estate would have to pay if they hadn't done that estate planning. Any portion over the estate exemption number is then generally taxed at 40% rate. So you get that first 15 million or 30 million for a couple without having the estate tax. It's just the amount over that you would have to pay the it's about 40% rate on that value. So again, you still get you get a lot of estates before you have to start paying any tax on it. But the amount of tax you pay on the amount that is over that is a big number. So putting some effort, time, and maybe some money into some estate planning can save your total estate quite a bit.
Right. So it's super important to talk to your financial planning advisors like us just to make sure that, if you do qualify for those exemptions, you want to make sure you're staying within those numbers because there might be things to do that you can with planning to help you avoid bumping over that
Mhm.
and then to be taxed at 40%. So that's why it's super important to be ahead of the game and do that planning before something happens and changes.
Absolutely. Yep.
Yeah. So tell us a little bit about like, is it the same for all states, Kelsey, or does it vary?
So this is where more people get tripped up, more than the federal estate tax, is the state estate tax. Now, it's a lot of words in there that are very similar. We're saying state estate taxes. So
Right.
depending on what state you live in, you may also have estate taxes due to your state in the event of your death. And that the tricky thing is it's not the same necessarily as the federal level. So 12 states and District of Columbia charge their own estate tax. Some estate taxes are the same as the federal level. Some are actually lower than the federal exemption. So you want to be aware if you're in one of those states, and very careful estate planning could save your family a lot of money. So pay attention to that. The one we run into, I think, most often would be Minnesota. They have
Mhm.
a different, as of 2026, they have a different estate tax limit that's
Yeah.
quite a bit lower than the federal level, and much more people are hitting that estate tax in Minnesota than at the federal level. So
Those
pay
are something that
attention.
can change every year, so you do have to
Mhm.
keep up on it because the state or the Fed, they might change those based on the year that you're in. So just because
Yeah.
you looked it up a couple years ago, it might not be the same. So you definitely want to keep up on that.
Yeah, estate tax planning is something you just want to kind of check in periodically. Again, with your financial advisor or with your CPA, to make sure that you're doing the right things based on what the current laws are. The
Hmm.
federal government did make the estate tax threshold, as we always say, permanent, right? It's now
Hmm.
this level until somebody changes it, and they did permanently allow for the inflation adjusted numbers
Hmm.
to be indexed up beginning in 2027. But states are a whole different ballgame. They all have different rules, they all
Yeah.
have different limits. So look at your state. If you are good on the federal level, still check on the state level and make sure that you're covered. Again, it's only 12 states in the District of Columbia, but if you live in one of those 12 states or that district, it is something you want to pay attention to.
Right.
So, if you're in jeopardy of surpassing the threshold, both on the federal or the state level, some things you'd want to do, like on the federal level, utilizing the federal annual gift tax exclusion, which in 2026 is 19,000 per recipient. And if you're married, both you and your spouse can gift that amount to any individual. So, for example, if I wanted to gift 19,000 to a child, to a sibling, to a cousin, to whomever, I could do that, and my spouse could do that, and we could get $38,000 out of our estate in 2026. And then each year they
Hmm.
have a number. It usually gets indexed every few years for inflation as well.
Right. So some good planning can help you save on that money. Plus, give it to your loved ones if that's your intent. So,
Yeah, and then looking into more advanced estate planning is also a good idea. So things as like irrevocable trust and other tools. Like if you're surpassing that federal level, that's when those really become beneficial. There's other reasons to use an irrevocable trust, but the most common one seems to be when we're
yeah.
getting close to that estate tax situation. So. All right, so that's estate tax. Now, Julie, what can you tell us about inheritance tax? Because it is different.
Right. So inheritance tax is the tax on beneficiaries for receiving an inheritance. So it's the tax to the actual person, right? So this is also kind of confusing to people because they understand that they've got the federal estate tax, and then this is inheritance tax, but this isn't taxed at the federal level. It's only taxed at the state level. And a handful of states do have inheritance tax. So that's where we want to make sure that people understand it. So it's based on the state, not necessarily the state that you're in. It's based on the state where the decedent lived. So the person who died, it's depending on where they lived or where they own property. So usually it's around about 2% of beneficiaries will end up owning an inheritance tax. Okay.
Gotcha. Is this the same for all beneficiaries, or does the type of person, the relationship matter?
Really good question because the amount of tax and exemption from this, it depends on the relationship of the deceased person, the type of assets, and sometimes the circumstances even in the place of death, right? So, for instance, in Pennsylvania, property transferred from a military member killed in active duty will be exempt from their inheritance tax. So there's certain situations and different scenarios that come up. So you definitely want to do your homework or do your due diligence and check in to see if you're exempt or if it in fact is going to affect you as well.
Okay. So in
Yeah.
summary, there's federal estate tax. Very few people actually have to pay that tax, but if you're one of them, you're going to want to do some planning.
Mhm.
There's state level estate tax in 12 states plus the District of Columbia, and then inheritance tax in some states. And it doesn't apply to every situation, but it
Mhm.
is in several states, and you'd want to understand. And if the state tax is charged to the estate, Inheritance tax is charged to the beneficiary who inherited that money. So,
Right.
this is why we're doing the podcast. There's a lot of nuance on here, and we want to help make sure because we get a lot of questions like, do I have estate tax or do I have inheritance tax? People tend to use those terms interchangeably, but they are different, and it is important to understand the differences in the tax code there.
And to make sure that you're planning for the right amounts to be able to pay for these taxes, because that's all part of the planning that we as advisors can help people do.
Absolutely. Want to understand what the bill is. What we hate to see is, you being forced to sell an asset to cover taxes. If there's things that
Yeah.
we can do to plan for it, to be, pick out which asset you want to use to pay for the tax if it's going to be due
Mhm.
and not get stuck in a situation where you just, bad planning or failure to plan, put you into a corner that you had to,
Right.
get out of in a way that you don't want to. So.
Yeah.
All right, so now we've got estate versus inheritance tax discussed. Let's move into another type of taxation at death, and that's on the actual assets themselves. Taxes are going to be due on most things, whether you pay them or your beneficiary does, but there is, again, some nuance to that. So, what else changes about taxes at death?
Okay, we know what the amount of tax due on non-qualified assets is changed at death. So tell us, Kelsey, a little bit about the step up in basis rule.
Yeah, so this is probably one of the most significant tax benefits to heirs. I don't have statistics on it necessarily, but anybody that's inheriting anything that is non-qualified, so not an IRA, not a 401k, not a pension, if it's
Mhm.
after tax dollars, bank accounts, personal real property, things like that. This is a benefit that would apply there. So a step up in basis means whatever your cost basis was before death for your beneficiaries, it gets stepped up to the value of the asset at your date of death. So let's start first with what's cost basis. So cost basis is what you paid for an item. So if you paid, $10,000 for an item, that is your cost basis. And then if that same item at your death that you still own is now worth 15,000, let's say, your beneficiaries get to use the stepped up basis. They get to move the basis for taxes to 15,000, which is your date of death value, therefore avoiding paying taxes on the $5,000 between what you paid for it and what it was worth at your death. So beautiful, beautiful rule. It means that all the growth that you hopefully experienced in your assets throughout your time of holding that asset is not something that your beneficiary is going to get taxed on. They get to only be taxed on starting at the point that they inherited it. So it's really great. So there's taxes that are just coming off the table for people who are inheriting that type of asset. Um, it does not apply, like I said, it does not apply to IRAs, pension, or other pre-tax assets. This is just for what we call non-qualified assets. So if you have brokerage accounts or investment accounts that are not IRAs, this is what apply. This applies to real estate and real property. And again, most non-qualified assets.
Right, like stocks and mutual funds, that type of thing too. So those things
Yep.
are going to be included in that. Yep.
So if you have a brokerage account or a stock account or something that you've held, one of those big Fortune 500 companies in forever, and you've been with them since they were pennies and on the dollar, and now they're worth tens of thousands of dollars, maybe, you get, your beneficiaries would get a step up in basis. And
Right.
planning is really important in this category, especially when you get to be later in life and you're pretty sure you're not going to spend all this money, we start really looking at the value of that step up in basis and how that might need to be preserved for your beneficiaries. So, again, you're always going to hear us say planning is important, but it's true, and it definitely
Mhm.
plays into here. So, for surviving spouses, they can get step up in basis as well, which is something that everybody realizes. So for example, it does depend on if it's a community property state or a common law state. Now, there are only 9 community property states. The
Mhm.
bulk of the states in the United States are common law states. And common law states, it's the spouse's solo, the deceased spouse, their solo assets, and then half of any joint assets would get a step up in basis. So, example again, if I owned an account in my name alone, 100% of that account would get stepped up in basis for my spouse. If I had a joint account with my spouse, half of the asset values would get a step up in basis. So if I had 100 shares of a stock, 50 shares, my half, right? My half would get stepped up in my death, and then the other half would keep the original cost basis as they would be kind of flagged as my spouse's half of that asset, right? So that's
Mhm.
common law states. Community property states, often you'll receive a double step up, so you could get the whole asset stepped up. In community property states, there's a little bit of nuance again to that, but in general, you do need to know if you live in a common law state or a community property state.
Right.
I'm mentioning this really specifically on spouses. Pretty often we're seeing non-spouse beneficiaries get the step up, but we are not always seeing the spouses get their step up. In the event that their spouse dies, we don't often see the surviving spouse get the step up. And what we're finding is every company where the assets are custodied is different in how they handle that. Some automatically do it, some wait for you to ask for it. And so it's something, I mean, I've seen it several times in the last 12 months where the spouse is not getting on record the step up in basis, and we've had to go back and ask whatever company they were coming from to get that done. So make sure, you are entitled to it. Make sure you're getting it. That's really, really important. So,
Yeah, it's a big savings on taxes, so it's super important. And so again, it's your due diligence to make sure you're looking through those new statements when they come in, and maybe before you're transacting or making any, trades, you're making sure everything is up to snuff where it's supposed to be for the new assets going forward in your name.
yeah, before you trade something,
Yes.
if you move the account from a joint account to a single account, which you're required to do at the time that one spouse dies, when it gets to that single account, making sure the cost basis is accurate before you do any trading,
Yeah.
so that you get the proper taxation that you're entitled to.
It can save you a lot of headaches too, instead of trying to do it after the fact, trying to go back and get it corrected.
Mhm.
That's why it's a lot, really important to make sure that you're doing ahead of time.
Yeah, yeah. So one thing we will say, don't rush through these through
Yeah.
claims. If you're a spouse or a non-spouse, don't rush through it. Make sure you're doing the right thing. Make sure all the pieces and the steps are getting done. Working with somebody like, Sterk Financial, to help you guide you through those things, and making sure all the I's and are dotted and T's are crossed
Hmm.
is can be worth
Super
a lot
important.
of money to you in tax savings and headache.
Congratulations to Mary Sterk and the team at Sterk Financial for earning a spot on multiple Forbes lists for 8 years running, including the 2025 Forbes Best in State Wealth Advisors and 2025 Forbes Top Women Wealth Advisors Best in State.
All right, so that is for non-qualified dollars. So, Julie, you want to share with us how qualified assets are impacted at the death of the owner?
Right. So these unfortunately don't receive the same step up. So qualified accounts are accounts that have not been taxed yet, right? So they are growing tax deferred. So it's your IRAs and maybe your retirement accounts, 401ks, things like that. Okay. So those do not escape the taxes due on these. You always have to pay them. So you're not paying them
Can't
now, but you
escape
have
the
to pay them.
taxes.
Yeah, you can't escape them. You can't escape tax on these no matter what you do. So if you don't pay them now yourself, then your beneficiaries will when they inherit the assets. So there's a couple different ways that this happens. So at first, if it's a spouse and let's say I passed away, then my spouse would be able to continue most qualified accounts as their own if they choose. So the account would then go into my spouse's name and he would just assume that account and have it just if it were his. Again, it's still staying tax deferred as long as he hasn't, cashed it out or sold anything, and it's still growing. You only pay taxes once you take the money out of that. Okay. So that's how it works for a spouse. If it is a non-spouse, or like, let's say, I passed away and my children receive the assets, then it will typically go into an inherited IRA status. The rules are different. So with a spouse, they can take it and distribute that account over their lifetime. With a non-spouse, for people who die after who have died after 2019, both traditional IRAs and Roth IRAs that are inherited, they must be distributed or liquidated within 10 years of, let's say, the person's date of death. Okay, so if I died within 10 years, my children would have to distribute out 100% of my Roth or my IRA that they received as an inherited IRA. whereas the spouse will be able just to continue it as their own. So the way that that helps them before it was changed, where if it was an inherited IRA, then the children would be able to receive it as an inherited IRA and they could just distribute it over their lifetime. However, is what's happening here is we're shortening up that time frame of when this money has to be distributed out. Because basically the IRS has postponed you getting, them getting taxes paid on these dollars the whole time it was in your name. And now they don't want to, postpone getting their taxes paid on that for a whole nother lifetime of another person. So that's why they're kicking that up a little bit and implemented that 10-year window. Okay.
Yeah, they want to get paid, and they said, okay,
Right.
you got tax deferral your whole lifetime. Now we're gonna give it
Yeah.
a little bit more tax deferral to your beneficiaries, 10 more years if they want it, and
Yeah.
then it's time to pay taxes. But it does require this does require planning. Like
Yeah.
this, if you have a significant estate, if you, I mean, it doesn't really matter the size, but some estates, the amount that they have to take out in that 10 years
Yeah.
can really throw a wrench in people's tax planning. Now, it's
Right.
it's it's not all bad. They got an asset for it. They just have to also pay taxes on it. But like if they're inheriting this and they have children getting ready to go to college or something like that, and they need to fill out the FAFSA forms and it's income based and things like that, really quality planning here can really help quite a bit. So do
We can
not,
try and minimize it the most that we possibly can, but still you're going to have to take a significant out every year. So
yeah.
the rule is by December 31st of the 10th year following the owner's death, that's the time when that account has to be depleted out. It's the age of the decedent, the age of the decedent doesn't have any impact to that rule.
Mhm.
So let's say we're going through this and you were taking distributions and then you didn't, you're a non-spouse inherited IRA and you haven't distributed the whole thing out within that 10-year, that deadline by December 31st of the 10th year, then there is a huge penalty that is assessed. So this highly encourages people to do that. It's a 25% penalty if you don't have it all distributed out. So that's
That's so
again
big.
planning and making sure, yeah, rain, that's a big red flag. So you want to make sure you're not, you have to pay taxes on it. Now you don't want to, tack on an additional 25% for that too.
Yeah, because it's 25% penalty in addition to the taxes. So
Correct. Yeah.
again, proper planning, not only in making sure you get it out in year 10 at the latest, but also intra time period in that 10-year period. When is it right to take the distributions? And so this all wraps up in income planning, right? It's
Correct.
how do you get the income you need when you need it? When you're forced to take income you don't really want, what's the best way to push that out? And looking ahead and doing some forecasting. Oh, it's very, very important on these. And this is kind of new because this just, what was it, Julie? 2019, I think, right? That
The CARES Act.
this
Yep.
changed.
Yeah. So
So,
that's important to be able to make sure you're doing this. But a lot of times we're able to help people who maybe know that they're gonna maybe come into maybe some additional inheritance or maybe come into a higher income. So it might be, important to maybe take some bigger distributions in the early years to be able to kind of balance out in the last year. So there's several ways that we can help people to, again, like we said, we can't get away from taxes on these, but we can help minimize them to the extent that it's efficient.
yeah. Well, and like if you inherit something like from your parents and you're approaching your RMD age yourself, then it
Mhm.
might make sense to take some of that inherited money faster to avoid taking it at the same time you're being forced to take your own RMDs, right? So tax planning and I always tell people we're looking at the tax planning not just on a year by year basis, but we're trying to look out over your lifetime and figure out what's the best way for you to pay the least amount of taxes over your lifetime with the information we know. Obviously,
Right.
it's always changing, so we got to pay
Yeah.
attention to that. But
I'd like to add that there are some nuances. There's certain type of accounts, maybe some types of insurance products that do have their own rules, right? So Kelsey and I just laid out that there's a 10-year payout period. You have to have it paid out by the, December 31st of the 10th year of the person's date of death. There are some products out there that have their own distribution rules, and you may not get the whole 10-year. They might have a 5-year payout or a deferral, where you can do things like that. So again, when you get, when you come into this situation where you're going to inherit assets, it's super important to go see us or talk to your financial advisor, because you want to make sure each product might have a little bit different rules, and you want to make sure that you're doing this in the best interest of yourself.
Yeah. Yep. And everybody's estates are a little different,
Yeah.
so trying to make sure you understand the rules for each type of account. I mean, I've seen some wild things, like very organized estates, but they still had lots of different things going on. And there's, on this asset, here's the rule. On this asset, here's the rule. On this
Yeah.
asset, here's the timeline, right? And it can be different for everything that you're taking on. So don't, my advice on all of this is don't try to go it alone. Don't be afraid to ask for help, ask for advice. Somebody guiding you through this process, if you find yourself a beneficiary, can be extremely helpful. If you find yourself receiving inheritance that is going to significantly change your net worth, in addition to making the right claims, then also looking ahead and seeing how this new wealth that you're receiving is going to change your retirement picture. That is something that should be done at that point, and figure out how that's going to, bless your family for the rest of your life. So,
Right. It's super important to not, like Kelsey mentioned this earlier, not to hurry and make rush decisions, because there's so many different moving parts in here. Again, we want to make sure this is set up for you. One of the rules is that you normally you have up to a year to make decisions before you file claims on, any assets that you're inheriting. So you have a year, pretty much a year window where you can make these get everything planned together and figure out how it's going to work best for you. So don't make rush decisions just because you think you have to make it right now, or maybe there's other beneficiaries that are waiting on a claim,
mhm.
until you get yours in. That's okay. You got to take care of you first. So make sure you're getting the right advice. And the strategies that are going to be best for you.
Yeah, don't rush. I've had,
Mhm.
oh, I could tell you stories of people that have come to me after they've done something on paperwork, and they're like, I just thought maybe I should ask somebody for some help now, and I'm coming to you. And then I start talking to them and figure out they've already signed paperwork. The check's already been cut. Once that happens, in almost every circumstance, it's irreversible, right? So
Okay.
before you sign claim paperwork, if you think you should, and I think you should check every time, but if you think you should check before you submit paperwork, not
Right.
after you get a check. That's the wrong
Yeah.
time, right?
Right.
And in some cases, I mean, in probably the worst case I ever saw, they did something. They were told by customer service at whatever company they called that they could do something. Those people gave them wrong information. Even though they gave them wrong information, they would not reverse the decision that was signed on the paperwork. And it ended up costing that person thousands and thousands of dollars in taxes that they could have avoided had that been filled out correctly. So, they got to me too late, unfortunately, and we made the most we could with what the
Yeah.
situation was. But just go slow and ask. Don't get in a hurry to get it done. Make sure you're doing it in the correct way. Find somebody that you trust to help you handle that.
Yeah. Great information. I know we covered a lot today. So again, if you have questions or this has sparked some interest, or someone or yourself who's affected by these situations, feel free to reach out. We'd love to help.
Absolutely. That's what we're here for. And hopefully you've learned something about death and taxes, or taxes at death, probably more so than the combination. So it's been great. Please reach out, and we'll see you in the next Money Guide.
Thank you, everyone.
Bye.
Thank you for listening to the advisors at Sterk Financial. We hope this has been informative and good information for you, and that it helps aid you in your journey of learning more about finance, money, investments, taxes, and different things like that. Have a great day.
Sterk Financial Services celebrated 20 years in 2024. The views expressed are not necessarily the opinion of your audio provider and should not be construed directly or indirectly as an offer to buy or sell any securities or services mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can ensure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should only be relied upon when coordinated with individual professional advice. Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance offered through Sterk Financial Services, which is not affiliated with Osaic Wealth. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. The rankings for the Forbes Best in State Wealth Advisors list by Shook Research is based on due diligence meetings to evaluate each advisor qualitatively, a major component of a ranking algorithm that includes client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and review generated for their firms. The Forbes ranking of America's top women wealth advisors is based on an algorithm of qualitative and quantitative data, rating thousands of wealth advisors with a minimum of 7 years of experience and weighing factors like revenue trends, assets under management, compliance records, industry experience, and best practices learned through telephone and in-person interviews. There is no fee in exchange for rankings. Forbes is a trademark of Forbes Media LLC. All rights reserved. Rankings and recognition from Forbes, Shook Research are no guarantee of future investment success and do not ensure that a current or prospective client will experience a higher level of performance results, and such rankings should not be construed as an endorsement of the advisor.